update in terms of the gas shortage in Europe, and US is expected to open travel in November. We're also going to talk briefly about the China Evergrande issue and how they're bailing them out. Then we're going to talk about a few quick investing accelerator updates where I added 2 new features. In terms of stock pick quick updates, we're going to talk about Suncor, airlines. Kelly requested a quick update on MasterCard, Visa, and GPN. Afterwards, we're going to briefly go through these ones as well, the medium risk stocks as well. In terms of deep dive, we have FedEx, Nabil EA, along with Take-Two and Activision and Blizzard. For Felix, it's just a quick update on Amazon Care and TDoc, which is a stock we covered previously. I'm also going to talk about some of the hedging positions that I currently have, which is for ACSU and Kirkland. Finally, I'm also going to talk about Disney because they have a slowdown in production, which led to a drop in stock price. Here's a summary analysis, and you can refer to this, or you can just skip ahead to the stock that we're going through. First of all, right now, the European countries have a shortage of gas. Oil and gas prices are at a high. Let me just show you the chart. So here, this reflects US oil, which is at around 60 to 70 something dollars per barrel, which I think is expected to go higher. So at this point, OPEC is planning to increase supply in the near future, but I don't think they'll be increasing supply fast enough to keep this price steady. Chances are it is going to shoot past 80 this coming winter. We'll just observe how that goes. Why is this important? This is important because gas companies will benefit from the commodity price increase. Recently, we have a position in Suncor. Here you can see since then, Suncor has been going up this week. I think as the European gas prices increase and the shortage worsen, this will continue to go up. I think it is still okay to enter as long as it is below $21. After $21 US dollars, then don't chase Suncor. Now, if you like other oil and gas companies like ExxonMobil, you can also see there is an uptick. Shell, which is RDS.A. So you can see there's also an uptick this week. This is more than just a Suncor increase. It is actually an overall increase for the entire industry. I think it's a matter of, you look at the financial, which one is growing the best, has the lowest dividend, has options, and also has insider buy. In this case, I selected Suncor as the investment. But if you want to select another one, like, for example, Shell, that is based in Netherlands, or BP, which is based in UK, then that is something you can look into. I would say generally oil and gas companies, they usually have a flat trend, or their dividend is high, or their growth is not as strong. Just make sure you do that research before you invest in them. It should benefit from a reopening of COVID, which has a higher demand on gas prices. Higher gas prices because OPEC is restricting the supply. Russia has a very low volume of inventory as well. Winter, there's also a very high demand for gas, and China is also using a lot of natural gas as well. So that is going to keep this commodity price quite high. So that's what this is for. The next one is China provided 18 billion liquidity to Evergrande through banks. Right now, the issue is temporarily on halt. Let me just bring up that article. So when you think about China, they're dealing with a couple of issues, which is tech regulation and also the real estate problem. The real estate problem is really caused by China having tighter real estate regulation earlier this year, which caused the stock price to drop and Evergrande not being able to raise more capital. And they can't openly admit they made a mistake. They can only help Evergrande indirectly through injecting money into the banking system. So far, they injected 18.6 billion into the banking system to help Evergrande. The next article is US is expected to reopen travel in November. Previously, I think the timeline was September, but right now we're almost the end of September already. Right now they are opening for vaccinated foreign air travelers in November. I think if there is even a slight delay, let's say it's December, I think that's the timeline we're looking at, which is this coming and the next coming earnings for the airline stocks and Christmas rush, then the financial results should come in January, February. So then if you want to take advantage of that, then you want to invest before the financial result comes out, I think that's where you will see the surge in stock price. Now, at the same time, Boeing also revised their forecast or continue to restate their forecast that Chinese airline will be buying 8,700 new aircrafts by 2040. This is more like a rumor. This is just a forecast, right? There's no hard contracts to back this up. I do think there is a very strong demand from the China side, even though right now they are closed off at the moment, which means they mainly have domestic travel and not a lot of international travel because they haven't gotten COVID under control yet. Nevertheless, because of this rumor per se, you can see Boeing stock prices going up. But let's first start by looking at Boeing's stock price. Here, you can see after they released this article, then there is a small uptick here, which is good. For this week, you can see Air Canada is going up this week, bouncing off the lower Bollinger Band, which is great. If you look at something like UAL, there's also a larger increase. This might be the first candle of the bottom ending. Then if you want to enter and you can get in around 48, I still think it is a good price to enter. Once the bottom is complete and it spikes past these EMAs, then you don't want to be chasing anymore. You will see this is actually an industry-wide thing because for DAL, you can see a similar candles being formed. When you're comparing between DAL and UAL, then you probably want to invest in UAL, whether it is lagging a little bit behind, but you're getting a deeper discount. If you want to invest in DAL, I think that is okay as well. Now, some people, I know you like Southwest Airline, and here you can see they're bouncing off the EMAs. This is the first candle indicating the bottom is over. Now, for Southwest, I do have some reserve over it because the CEO is stepping down to become board of directors in February. I think that is probably the main concern. So let's say it goes up by a couple of months, which you'll probably be able to make a good profit at this stage. By February, there's probably going to be some panic around a new CEO, and then it will come down again. That's my expectation for Southwest versus where I think it wouldn't have that issue for Air Canada or Boeing as well, which is why I have these two instead of Southwest. Okay. What I just did was I actually covered this here in terms of quick updates. Now, the next article is actually Disney is showing slower user growth. Then I actually have Disney as a stock pick near the end of this video, and we'll cover that by that time. Okay. First, let's talk about Suncor. This is a stock we covered August 12th, and I talked about the US oil prices at a higher demand due to economy reopening. The bottom is basically complete unless there is going to be a second part of the W, which let me show you what I mean. Here is Suncor. You can see the Bollinger Band is expanding, right? Which is one of the red flags I told you about, which is why we bought a put protective position in case there is a W forming later on. But in terms of the first part of the W, you can see it should be going up for the next couple of weeks. And with the macroeconomic environment also being very positive for Suncor, we'll be taking off Suncor off the quick update. Basically, the next time we cover it will likely be the time to exit. Now, the next one is airlines. We talked about this earlier, and basically, I think the bottom for the airline is almost complete or basically complete, according to this week. And going forward, if US is also reopened to Europe and Canada as well, then the financial results should reflect that, which means they will be back to 100% utilized soon. All right. Once the airlines spike, then I'll be taking this off the quick update as well because the entry zone is complete. Now, next one is Kelly. So you're interested in entering either Visa, MasterCard, or GPN, which is the payment stocks. If you look at Visa and MasterCard, historically, you don't really get that much discount. I think you also included AXP here as well, which I didn't enter. If you look at AXP, here you can see it is at an all-time high. I wouldn't chase AXP for now. I think instead you can look at Visa and MasterCard where the formation is more similar. Between the two, I think MasterCard right now has a slightly deeper discount. If you look at MasterCard historically, you actually don't get that deep of a discount. So if you want to use stocks to buy and hold MasterCard or Visa, I think that is fine. Is a pretty safe play. Now, if you're interested in a stock that has a deeper discount, which is Global Payments, then here you can see it actually dropped between the red and the blue EMA, which usually it does not drop. This is a rare opportunity to enter into GPN. Now, one thing you do note is that the Bollinger Band is expanding. Previously, I think some people try to enter near the blue EMA, And this is an example where sometimes you might get into the position early so then you can lock in the price, but it doesn't necessarily mean the stock price will go up right away. If you think about why you want to invest in GPN versus MasterCard and Visa, it really comes down to whether you want to use options or not. For MasterCard and Visa, it is a little bit risky to use options. You might want to stick with stocks for those ones. Whereas for GPN, you're getting a deeper discount. I think there is a better rationale to use options, but you want to wait for a bottom to mature. What you're looking for at this stage is price to hover above the blue EMA continuously for a while until this Bollinger Band lower part is flattening out or curving in. I think that is usually your clue. Basically, it should be kind of stabilized at this 155 to 170 range until the next earnings report come around. That's kind of how I would think about it. If you're using MasterCard and if you're using stocks for MasterCard and Visa, I think that is fine. All right, the next one is Goose. This is also another one I'm watching as well, but I haven't invested in it. Here you can see it is actually hovering within this area. There's also share buyback as well, and winter is also coming. I do expect Goose to be going up, but I just haven't seen the candle I'm looking for, which will give me the indication that it will break out. I'm still waiting to see if it will mature any further before investing. The next one is Intel. For Intel, it is actually forming a bottom, and recently they actually started their manufacturing buildup, or they just start breaking ground to build that facility, which will take approximately 2 years. I think that's quite positive for Intel. Right now, there is still a chip shortage as well. I think if you're looking to enter into Intel, I think this price is okay to enter half your position, just to be conservative, because you can see right now the Bollinger Band is flattening, and it is okay to use options for Intel. Now, ideally, you want to save some of your money so then you can enter below 50 in case there is any additional bad event that happens. Because you can see for Intel, historically, it does kind of dip below this blue EMA a little bit more than other stocks. That's why I said you want to only enter a portion of your position. Now, there's also another stock that I'm watching, but I'm not as familiar with, and that is MU. I think earnings is coming up next week or so, if I remember correctly. And you can see the Bollinger Band is flattening. I've been watching this stock, but because I'm not as familiar with this company, I probably wouldn't be investing. If there is positive earnings, which is what we're expecting, then it might jump up to around $84 or so. Let me just pull this up. It's going to be released Wednesday. This is coming up Wednesday, so you still have 2 more days, which I do expect it to be going up. The reason is because when you're looking at this trend, they are opening their new facility. They are ramping that up, which means they should expect higher earnings and higher revenue. Here you can see for the next couple of quarters, the next 12 months, actually, they expect it to be doing well. For revenue, they're expecting to be going up as well. I think that is really the underlying driver for MU to go up. But having said that, my concern would be they're still insider sell. I try to avoid investing in anything that has insider sell because there's obviously a reason why they're insider selling. And MU is also heavily influenced by chip prices, which is a very competitive market. The next one is Take-Two, Activision, Blizzard, and EA. We'll talk about this when we are analyzing the stock for Nabil here. And the next one is LMT. For LMT here, you can see that this is actually the first week it is rebounding. The Bollinger Band is still expanding. I do think that this is looking like it is a good W formation. Now, when you're thinking about the defense industry, so far Biden hasn't released anything important on it yet, which will make me think that LMT do drop even more. I think chances are it is going to be stabilizing at the blue EMA. I think it is still early. You probably want to watch for a couple more weeks to see that this candle is getting out of this line, the Bollinger Band. So you can see something like this, where it is getting out of the Bollinger Band, so it's not touching it anymore. At that point, I think you can invest if this is something you're interested in holding. The next one is Apple, Facebook, Google, and Disney. These probably don't get you that much discount. Apple has been dropping for 2 weeks because of the App Store lawsuit. Right now it's going back up a little bit, but you're not getting too deep of a discount. So if you're interested in using stocks, then perhaps you can use stocks, but personally I wouldn't be investing in it this time. For Facebook, they also have like a conflict with Apple regarding human trafficking. I think that's why it's going down. When you're looking at the big tech, they are expecting to forecast slower growth in the next 6 months. I think that is also another reason why it is driving down the stock price. For these stocks, if you are interested in being patient and wait for it, then try to wait for the lower BP band at the earliest. If not, usually I wait for a deeper price like the red EMA. For Google, not dropping is not really on a discount. For Amazon, you can see there is a pin bar in the middle of the Bollinger Band. Chances are, if you want to invest in Amazon, then it will just be shares without any discount. That's just what you need to be comfortable with. All right, so the next one is TDoc, which we are actually going to be covering as a quick update down here for Felix. We're going to skip that for now. Next one is Vertex. So for Vertex, the earnings is actually coming out in early November. Right now, the stock is still dropping. There's actually insider buy, but we haven't seen an upward candle, which will make us think the bottom is forming or has completed yet. You can see the Bollinger Band is actually slightly down. It's not flattened yet. But I think it's a matter of waiting. There's no need to jump into Vertex yet. Pins. This one has slower user growth earlier. Right now, you can see the stock price is stabilizing above the red EMA. If you want to have a small position, I think you can because the Bollinger Band is still expanding. I think until the Bollinger Band is flattened, there is quite a high possibility where it might drop below the red EMA, given all the other big techs are forecasting a slower growth in the next 6 months. The next one is Baba and Tencent. For Baba, it is really weird, but it hasn't stopped dropping yet. That means the bottom hasn't formed, and you can see the Bollinger Band is still expanding. It's just a matter of waiting. For Tencent, you can see price is starting to stabilize at the blue EMA level. The Bollinger Band is still expanding. I would say the bottom is forming now for Tencent, which is great compared to Baba. So I would still say just wait for it because there are quite a few issues with China right now. So don't be overexposed to any Chinese stocks. The first stock pick is Shurkesh and Mark, FedEx. It is on a discount now. It is down due to earnings miss and lower forecasts. If we hold this stock for 6 months, is there any chance of doubling your money? I would consider FedEx to be a COVID benefited stock, such as Apple, Facebook, and right now others are expecting a slowdown in the next 6 months. So do you see a general decrease in terms of volume for these stocks? Good earnings is expected to come in June 2022. Right now, you're still early. Keep watching FedEx on a weekly or a monthly basis until it forms a bottom. You want to invest in this as late as possible in terms of bottom formation. Here is the analysis for FedEx. You can see everything generally check out other than the fact that the bottom is early and there's insider sell. First, let's look at insider. And here you can see it is quite straightforward. It's insider sell with some grants back in June. Okay. Let's look at the chart. Now, previously, FedEx terminated their partnership with Amazon. That is the drop back in here, 2018. And afterwards, it flattened out for a bit, COVID, and then afterwards, it bounced back significantly. So now, as we are coming out of the supply chain crunch, and there's less people sending masks all around the world, then FedEx is seeing an earnings miss and also lowering forecast. And I think that is actually quite reasonable. That's why you see there is this big drop and the Bollinger Band is expanding as well. When you're looking at a big drop like this, the Bollinger Band is expanding. It means that you don't want to be getting in early. But that's why I said track this on a weekly basis until you see a very solid bottom. You want to wait for the stock price to get out of this Bollinger Band area. Chances are, my guess is that it wouldn't stop at this blue EMA. It will probably go even lower. And once you see a solid bottom, then you can choose to invest in it. Because if you're investing too early, then it wouldn't be as easy for you to double your money in the next 6 months. Try to invest once you see a bottom to be very mature. For example, something like Suncor, you can see I invested in this week, which is way after the drop. You don't need to wait in the market as long. So right now, it is early. Don't invest yet. Now, when you're looking at the financials, on average, FedEx does have a growth of around 6 to 8%, but for the pandemic year, they have a growth of 21%. So I would say this is not a sustainable number. Chances are it will come down after the pandemic's over, which you should be seeing this year because they are lowering their forecast. Here you can see they're making quite a bit of money as well, so I think that's fine. When you're looking at the quarterly, you will see the slowdown here. So From May to August, you see a 10% growth quarter over quarter. And afterwards, you see this number is dropping. And if they're lowering their forecast, which means they think it is going to be dropping even more, I think it makes sense that the stock price is dropping for now. Here you can see the profitability is improving after COVID, which is what we expected anyways. Now, when you're looking at quarterly, here you can see the cash is relatively flat. There is sufficient cash, so I'm not too worried about it. If you go down to debt to equity ratio, it's approximately a little bit higher than 2 times, maybe 2 point something times, but I think that is okay. Let me see what I wrote here. 2 times, yeah. In terms of why it is dropping, the first reason is because there's higher labor costs, supply chain issues, and so they miss earnings and they're lowering their forecast as well. I think with a combination of these factors, the bottom should take a while to form. Probably you want to wait until they release another earnings and a little bit more. So in terms of dividend, it is quite low, 1.19%. I think it is fine to use options. If you're wondering when they would have a spike or when the bottom would form, then just look at the next 2 earnings. You can see there is actually a slight decline here compared to these 2 quarters, and they miss earnings here. I would expect wait till 1Q 2022. They do have an off year end. You just got to keep that in mind. This Q2 is actually June 2022. If you ask me, can you make double your money in 6 months? The answer is probably not right now. But if you invest closer to December or even in early spring, I think you might have that potential. That's kind of what you're looking for in terms of when to enter. If you refer to this website, which is just a little bit more visual, then you can see that the earnings is expected to flatten out for the next 2 quarters until this Q4 2022. Because they have an off year end, this is actually June 2022. So you want to invest before this time, but not too early. Right now, you're still on the early side. You have around 6 months where the bottom will form. If you go to revenue, you can see they do expect increase in revenue, not too much, until June 2022. Okay, I think what you want to pay attention to is mainly earnings because that's what they got penalized for last time, which is why the stock is dropping right now. Then for the next 2 quarters, they do expect it to be flat. I think right now it's still early to invest in FedEx, but when the time is right and the bottom is maturing, then you can choose January 2024. So by that time, let's say you're waiting another 3 to 6 months before you enter into FedEx. At that time, I think you can choose January 2024, and then you can choose a strike price by that time. Overall, I would say FedEx is low in terms of risk rating. You would decide to hedge in this case because you're early, but then you don't invest until the bottom is mature, okay? So that's why I put down there is no strike price or stock price here. Just observe it until you see a solid bottom. The next stock is Nabil EA. What are your thoughts on EA right now? Their stock has dropped about $18, but since they announced Battlefield 2042 will be delayed until November. On the day of the announcement, an insider sold 1,000 shares, but hasn't sold since, potentially indicating that he thinks the stock is undervalued. I tried giving a look at the ratios, but they're all outliers. I also looked at their financial statements and saw some fluctuations manually, but I don't really understand why. I know it's too early to tell, but do you think EA could recover from this soon? It went down due to their recent announcement being delayed. I think for now it is a temporary problem, but I think the game releases in a bad state, then the backlash would cause the stock to drop even more. I don't think it is likely, but it is a possibility. Now, the quarterly earnings fluctuates due to seasonality, the launch of games, E3, which is mainly in summer actually. They do expect holiday season to be performing well. Now, my concern is that right now, Activision and Blizzard, Take-Two, and also EA represents an industry decline. We'll talk about that in a bit. Observe them to stop dropping first before investing. Now, another concern would be investors think that the post-pandemic growth for gaming will be slower, which I don't think is necessarily true, but I do see where they're coming from, which is why the stocks are going down. Okay, here we are. This is the chart for EA. Now, before that, let me just jump to the summary analysis here. And we actually covered Take-Two. Let me just go back up here. We covered Take-Two in July. We covered Activision in August. And right now we're covering EA. If you want to look at the analysis for these two, just go to the dates here for the coaching calls, and then you can look at them. So for comparison purposes, I've actually put it here so they can see clearly between the 3 companies how they're doing. They're all gaming companies, and they have a strong trend, and their bottom I would consider to be early for now. So for EA, Right now, the reason for dropping is delay of Battlefield 2024. You said it's November, right? But from the articles I found, it seems to be October. But yeah, for Take-Two, they are also delaying their GTA, I think it's GTA Online as well. There's also a tech sell-off. And for Activision and Blizzard, they have a sexual harassment lawsuit with the Blizzard's president and a few senior designers as well. So that's why I've put this down as medium risk. Without a president and a couple of the key designers, then I think Diablo 4 and a lot of other games will experience either a delay or a setback. That's why I think Activision and Blizzard is higher risk. First, let's look at the technical analysis for these three stocks. You can see after they recovered from this 2019 low about loot boxes, they have been at a high price. Take-Two, the trend I think is actually stronger than EA. And for Activision, the trend is also stronger than EA as well. And what I'm looking at here is really this part. So here you can see for EA, since July, they actually flattened out, but they're actually unable to break through this 150. Whereas Take-Two, from July onwards, they still have this rally, and then it came down. And Activision Blizzard, they have a rally as well. I think from a trend perspective, I do think these two companies are better than EA. Now, for Activision and Blizzard, I do think they have more of an issue because they have these sexual harassment lawsuits. And right now, the Bollinger Band is expanding for Take-Two, Activision Blizzard, and EA as well. But I think if you're asking me, this looks like an industry-wide correction. I don't think you need to be in a rush to get in. If you do really want to get in because you think you might miss the boat, then just try to enter 1/3 of the position you want to buy. Then you lock in a small position first. But in my opinion, I think you should wait until you start to see that these other two companies is forming a bottom. For Take-Two, they probably will form a bottom near the blue EMA. Within the next 4 to 8 weeks, you can probably see it coming out of this blue EMA area or the Bollinger Band area. At that point, you will see the Bollinger Band is flattening. For Activision and Blizzard, it might do the same thing as well, but because they have the whole change in president, I think this issue is a little bit too complicated, so you probably do not want to be investing in Activision and Blizzard. So the next one is EA. If you see a similar formation near the blue EMA, then you can consider it as well. Of course, there is a slight chance it might form a V-shaped bottom, but then I wouldn't bet on that given the other two companies are also dropping as well. When you're looking at insider, here you can see there's a lot of insider sell before the drop. After the drop, you ask, well, why is there no more insider sell? Sometimes it might just be because the insider hasn't updated their transactions yet. That's why you don't see insider sell at the moment. If you just look at this chart and you scroll down, then you can see there's actually a mix of grants and also insider sell. So you would just treat this as a mix in this case, or leaning towards insider sell. So that makes sense because when you're looking at the price action here, the reason why the stock is not going up is because there is a lot of insider selling. Hedge funds or whatnot wouldn't be buying into this stock at the moment at this high price. Now, when you're looking at EA, historically, they do have a good level of growth, given that they're a relatively big company, from 7 to 10%, including this slight dip here. So if you just lower that as maybe 5% per year. And for 2021, there's growth as well. For this number, this actually seems a little bit lower than I imagined, because I think that they benefit a lot from the COVID boom where people just stay at home and play games. Here, then you see net income. It fluctuates quite a bit. There's actually a little bit of noise in here. We look at why that is the case. It's mainly because this year they have a tax rebate of $1.5 billion. If you take this out, then that actually lowers it to around 1 to 1.5 billion of net income per year. In terms of whether they have any unusual expense, it's mainly because they spent a lot more money on marketing here and also R&D. That led to an increase in costs, which decreased their profitability. I would say on average, they're making around about $1 billion a year. This might be off by 200 mil, 300 mils. The difference you're looking at is really around here, where they increased the SG&A expense by 300 mil and R&D here by 200 mil. So that's 500 mil you're looking for. If they're spending money on marketing and also research and development, that's actually fine, because as long as they produce good games, then eventually they will recoup that cost. When you're looking at the quarterly financial statements, you see there is seasonality that is in place. For example, December is a relatively good quarter for them because, of course, Christmas. And afterwards, you also see June. This is probably due to E3 as well. What you want to compare is really the June to June quarter here, which you see there is an overall growth. Now, if you scroll down below, then here you will see the profitability actually declined slightly in terms of net income from 365 down to 204. If you're looking for a reason, it's because they have higher SG&A expense and R&D. Basically, they're putting more money into marketing and research. Right now, their revenue is not increasing as quickly yet. So it might eventually pay off near the Christmas season. That depends on your understanding of the company and the games that are coming out. If you do a bit more research on Battlefield 2024 and you think it's okay, then it might get paid off during that time. Now, when you're looking at cash and you're trying to understand why the cash here is declining, this is mainly due to acquisitions EA has made. Here you can see the cash has been declining for the last 2 quarters. If you jump over to cash flow here and you click quarterly and you scroll down, you will see there are 2 major transactions that are called net assets from acquisitions. That's what used up their cash, which I think is fine. It's just EA's way of expanding. If you scroll down here, then you can take this 5 billion divided by 7.7. The debt to equity ratio is actually less than 1-to-1. I put down good here. The article I found just a week or 2 ago said it is delayed till October, but not November. The date you found might be more recent, but I think either way, that's okay because we understand what the issue is. Before we continue our analysis with EA, I just want to take a minute to kind of compare the income statements between EA, Take-Two, and Activision and Blizzard. It gives you a feel on why I think the annual growth number was low in the most recent year. Here you can see for Activision and Blizzard, the growth is around 6% per year other than 2019. And for 2020, it was actually 25%. This number makes sense to me because of COVID. Now for Take-Two, in 2019, I think they have an acquisition, which is why there's a jump in terms of revenue. And then since then, they're growing at 9% as well. In that case, which explains their trend, I think that's fine. I need to double check if this is an acquisition or is actually a game release. When you're looking at EA here, you can see the growth is similar. For COVID, I'm actually surprised the growth is not as strong as I thought. I would say between the growth of all 3 companies, EA is on the slightly slower. Let me just go down here. If you're looking at for efficiency, for example, Take-Two is making around $3 billion and net income is around 400 million. Let's take a more conservative 500 million, right? And for EA here, they're making around $6 billion and their net income is around $1 billion. We want to exclude this tax rebate. Let me just quickly calculate what that ratio is. 1 divided by 5.5, that is 18%. That means for every dollar they earn, they get to keep 18 cents of it. And for Take-Two, 3.4 is 18% or 17.6% as well. It's actually fairly similar. If you look at Activision and Blizzard, they are growing at a similar place. Here is 8 billion revenue and 2.2. So 27. Let's see if there's an outlier here. This number seems relatively high, 6.45. So 23. For Activision, their margin is higher than the other 2. It is mainly because of World of Warcraft. So between the 3 companies, Activision is actually more profitable in the sense where you can see the revenue figure. It is bigger than the other 2. Also, the profitability, which is the money they get to keep, it's also higher than the other 2. Let me just quickly take a look at the quarterly financials to see if there's any additional insights I can offer you. For quarterly, for the last 2 quarters, Activision is not growing that much. And for Take-Two, they're actually having a slight decline as well after December. And same for EA. Chances are we do need to compare the year-over-year quarter instead. In this case, the only one that grew is actually Activision and Blizzard. Yeah, I think between the 3, Activision probably has the strongest in terms of financials, but I don't think the issue of the sexual harassment and the change in Blizzard president is over yet. You probably need to be more patient if you're waiting for Activision. But other than that, I think between Take-Two and EA, they're pretty similar. It's just a matter of what kind of games they're going to be releasing soon. Whereas Take-Two is, you will get a better discount because right now it's between the red and the blue area. For EA, you're getting less of a discount. And I think it's mainly because for the last 2 quarters, Take-Two has a slight decline. where if you compare this number, there's actually a decline versus EA, there's a slight increase. Okay. For dividend for EA is 0.54%, was pretty low. You can use options. And for earnings, they are expecting really good earnings in 2 quarters. Basically Christmas, which should be coming out near January, February. If you're looking at EA here, then watch for the next couple of weeks, because you still haven't gotten to Q3 earnings yet, to see if it forms a bottom. If it forms a bottom around this area, then you can enter once it is more mature. For Activision and Blizzard, they are expecting a Christmas sales bump as well. For Take-Two, there isn't as much of a bump in terms of Christmas sales, but they're actually expecting to do a lot better in mid next year. Looking at that, probably what you want to do is, if you want to invest in near term, then probably EA or Activision, if for some odd reason you're comfortable with the sexual harassment lawsuits. In closer to the summertime, then Take-Two will be a better choice. So it depends on when you observe the bottom and how mature it is. If you are then investing in EA, try to use January 2024 option after a couple of weeks, and chances are you want to use a strike price that is the blue EMA or below. Watch for where the bottom is forming and then use a strike price that's below the bottom. Chances are you want to use a strike price that's below this point, this pin, and it's going to be below 108. Just see how much of a discount you can get for EA. The next stock is Felix. Amazon Care versus TDoc. TDoc is making a statement where they're not afraid of Amazon, but I think we should expect Amazon to take up significant market share in the future as well. Given the industry itself is growing quickly, TDoc should continue to grow for years to come. The question submitted by Felix was really, should we be concerned about Amazon going into the healthcare market? Here is the article from Motley Fool, where Amazon is actually heading into the virtual healthcare market as well. Teladoc is saying that they're not worried about it. I think right now Amazon is starting, they are playing the catch-up game, but I think when you're looking at this market, there can be multiple players, like 2 to 3 large players as the end game. I don't think necessarily it is a bad thing. When you're looking at the market, the CAGR, which is the compound annual growth, is 24%. Even if going forward, Amazon and Teladoc is taking up the share 50-50, they should still be able to grow at 24% per year. I think in terms of the growth hypothesis is there because the market is expanding. And right now we're in a post-COVID world, so that's why Teladoc is down. What you're really waiting for is really some kind of uptick before the earnings, then you would invest in it. So here you can see a bottom is actually forming, the Bollinger Band is starting to flatten, and in the recent week or two, it is starting to expand a little bit. What you're looking for is really an upward candle, an white candle that will give you an indication that the bottom is complete. We have been observing this for a while now, but so far we haven't seen it yet. But basically what you're looking for is a candle like this, similar to what we're seeing in Suncor here, or let's see if we see one for Kirkland. This one's harder to see because I have all these lines. These type of candles where it signals to you that the bottom is over. I think if you are looking to invest in TDoc, I think the company itself is growing very rapidly, and they recently completed their acquisition as well. I think there is a very strong reason to invest in it. There is insider sell. I would say just wait until you see a candle which signals a change in trend from this currently correction once the bottom matures. Okay, the next question is how to think about hedging. Right now, there are 3 hedging positions I have. So the first one is Suncor, and I have it for December 17th, 2021. As of this moment, my call position actually already fully covers the put position that I have. So I'm not too worried about it, and chances are I'll hold on to this put position until it expires in December. The reason is because the Bollinger Band is still expanding, and it is very likely that Suncor will form a W if it encounters some resistance here at the red EMA. At that point, I want to have the put position as a layer of protection. Ideally, if Suncor continues to go up because the gas shortage worsened, then I think the put option will expire worthless, which is the best case scenario. The next one I have is AC. For Air Canada, The Bollinger Band was expanding a little bit as well. That's why I have a position until November 19th. Chances are I'm going to be holding this until expiry as well. The reason is because Air Canada's earnings is being released the first week of November. That's like November 2nd or November 3rd. That's why I want the protection until earnings is out. So if it goes up to here and it shoots higher because they're releasing better earnings because people are traveling in the last couple of months, then I think that's great. Ideally, we want the put option to expire worthless. The next one is Kirkland Gold. So here you can see that for gold prices, we previously expect that it would go up to this 1900 level, but it didn't. Right now it's kind of hovering and getting closer to this 1700 level again. Now, surprisingly, even though it is coming down to this red EMA, Kirkland Gold is actually going up. I think the combination is really that Kirkland Gold has been performing well as a company, and also there's insider buy as well. That's why the stock price is going up, because historically, the trend for Kirkland Gold is quite strong anyways. Here, at this point, I bought a put position just to protect in case there is a drop in gold prices, which lead to any temporary decrease. But I expect that given the insider buy, the company redemption of the shares, this should push Kirkland Gold higher at this point. So ideally, I do want the put positions to expire worthless as well. The last stock pick is Disney, and they say there are COVID production delays, which lead to lower subscriber growth for Disney Plus. As we step into the post-COVID world, I actually think the growth for Disney wouldn't be driven by Disney Plus. Instead, it will be driven by Disney theme parks and movies, which are going to be released in the next year or Christmas, like Spider-Man, Doctor Strange, and Ant-Man and more. So next year will be a year of growth for Disney. The window of opportunity between today and Q3 earnings release is getting smaller. We'll need to watch very carefully whether there is an opportunity. So it's around, 47 days? Okay. So let's look at the chart for Disney. Earlier the week, Disney was actually touching the lower BB band, but then on Friday, it rebounds back up to here. We'll have to see if we get a deeper discount with Disney. If Disney goes back down to this red EMA level, then I do think it is quite a good buy. If it is hovering within this range, then I would say is an okay price. Is not at a very deep discount, but if you want to use shares at this price, then it's probably okay. But chances are you want to be waiting for a discount, which is closer to the red EMA or lower. Now, when you're looking at this article, they're basically saying that there is a production delay, which will lower the number of streaming clients. I think really, as we step out of COVID, there's going to be less subscribers for Disney Plus, which kind of makes sense to me. But on the flip side, the theme parks and all the other stuff will be reopening, which should benefit Disney. Here you can see there are some grants, and there are also some sales as well. Here I put down mixed with grants. For Disney, they generally grow around 8 to 10% per year, other than the year of COVID where movies and theme parks are closed. They actually made a loss here, and previously they're making around $10 billion. If you scroll down to quarterly, then here you can see their growth. I wouldn't say it has slowed down as well, because you can see June here, the year-over-year growth is still 9%. And I think near December, as more movies are being released, that should benefit them as well. If you go here, then I think you can see they're restoring profitability, which is fine. Now, when you're looking at a quarterly basis, they do have a lot of cash. I'm not too worried about that. And if you scroll down, then it's 1-to-1 debt to equity ratio, which I think is okay. So far, they actually stopped their dividends since 2019. When you're looking at the earnings for Disney going forward, they're actually expecting a very good fourth quarter, first quarter, and the second quarter as well. That's why I said the window of opportunity is really between today to Q3 earnings being released. It's actually Q4 earnings being released. That's where you get the uptick. Hopefully, the window of opportunity is that you'll get a discount down here, close to the red EMA, between now to Q4. Afterwards, it will continue to go up. But that's kind of what you would expect. And if you're looking at this earnings website, let me just take a quick look here. They are expecting earnings, revenue to be going up in this case for the next quarter. For earnings, they're expecting to be flat next quarter. And for the next 3 quarters, it will be at a higher level because the economy is reopening, people are traveling, so on and so forth. Finally, there are options. So at this price, I don't think you really need to use options because the risk is higher. Once it is closer to the red EMA and you see the price is stabilized and forming a bottom, then you want to use a blue EMA as your strike price. And you will need to observe how far it is dropping to know that. We'll circle back to this and we'll just keep watching it for now. So that's pretty much it for this week. And let me know if you have any questions. Welcome back to February 11th, 2020.